Morning to everyone, and great to be here with you today. So my name is Andrew Maxon, one of the partners and valuers at InteleK Business Valuations and Advisory. So go figure, two things that effectively we do at InteleK. One is business valuations of all businesses in sectors and industries across Australia and also the US, and then also the advisory piece as well. So effectively in today's presentation, I'm going to touch on both parts. The first part, we'll be looking a little bit more at what I call the boring stuff, which is valuation itself. So running through some very high level theory and technicals around how to value a business, what it means, and also some misconceptions or pitfalls that we consistently see, along with the types of valuations, that business owners can request or use. So quite often valuations are either or clients engage valuations that are inappropriate for their situation, or the report is not so useful for their purpose. So I'll touch on that in a moment, but we'll start off with about 20 minutes looking at the boring stuff, if you will, and then shift on to the magic, as I like to refer to it, which is the second part, and very much that's the advisory piece of what we do. So once we have accurate or reliable valuation, then it's a question of how do we actually use this? The valuation itself is a process, but then how do we use valuation to the business owner's ultimate or maximum advantage? So that's what we'll touch on in the second part of the presentation. Now, needless to say, if there's any questions, please jump in as we go. Happy to answer. Otherwise, we'll have sort of 15 minutes for Q&A at the end. So shifting into the theory. Now, I would like to focus on the right part of this slide initially. So when we're valuing a business, and in particular valuing a privately held business, but this is the same whether we're valuing a public company trade on the ASX or for a privately held business, there's three things that we consider. So for any business owner, as you're going through your life in business, you need to be conscious of and thinking of these three factors because ultimately they impact valuation. So three very basic factors. One is growth. Two is cash flow. So cash flow, you can think of that as some measure of profitability, right? So your profit margins, and then there's some other adjustments, but effectively cash flow, growth, and then risk. So the riskiness or the volatility to those cash flows. So ultimately valuation can be quite complex, but they're the only three factors at a very high level that we're thinking about or that we're considering. So as the business owner yourself, it's great to be conscious of them in day-to-day operations or through in the business life cycle, any of your decision-making, effectively from a valuation standpoint. If you're going, is this decision material? Is it impacting growth, cash flow, and risk? And if so, to what degree or how so? So effectively then, the chart that I've got on the left here, so lots going on there, but I just want to focus then on the three approaches to valuation, being the column on the left in yellow. So we know now that when we're doing valuation, we care about growth, profitability, and risk. Now, to capture those factors to value a business, there's three approaches that we use: income approach, market approach, asset approach. So I won't go deeply into the detail, but effectively the income approach looks at the cash flow to that business and the expected future cash flow in the years to come. And then it discounts those cash flows based on their riskiness back to today, which also captures growth prospects for that business. So typically speaking, the income approach is what's used to value businesses that are obviously cash flow positive, so they are profitable. Now, the second approach here to valuation is called the market approach. And effectively, the market approach is to value your business. We will go out and have a look in our transaction databases for transactions of similar businesses to yours. So ultimately, that won't be the exact same business, but it's a business that has similar characteristics, in particular, conscious of growth, cash flow, profitability, and risk, to identify the value of your business. Now, let's say your business is a startup that's not yet cash flow positive. In that situation, then the market approach is what we would most commonly use to value those businesses. And in that situation, it might be a multiple of revenue. So the business does have revenue, but it's not very much, and it's certainly not cash flow positive yet. That's where we would certainly use a market approach. Equally, we can also use the market approach for highly successful or late-stage businesses that are cash flow positive. In that case, we might end up with a valuation under the income approach as well as the market approach. Now, the final approach is the asset approach. And in a very basic sense, often this is referred to or thought of as the book value of the assets on a business's balance sheet. Now, one limitation to the asset approach is it often does not capture the value of any intangible assets. Now, not sure exactly what sort of industries we've got here today, but obviously in 2023, a lot of the value in privately held businesses is of an intangible nature, which does not appear on a balance sheet. So typically the asset approach is used a little bit more frequently for businesses where there's a lot of tangible assets that appear on the balance sheet, and we can identify the value of them relatively easily. But if there is intangible value in the business beyond the value of any tangible assets, that is typically captured through the income approach or the market approach. So let's say you've got a service-based business in particular, quite often the asset approach won't even be used because there's not really many tangible assets on the balance sheet. Rather, we'll consider the income approach and the market approach only. So those three approaches, again, in terms of valuing a business in a reliable fashion, they must be considered. And then ultimately they're the three factors that we want to keep in mind. What's the growth profile of my business? How's its cash flow? And what's the riskiness to the business operations and the cash flows in general? Any questions on that slide? That's probably the most technical slide that I've got. I don't want to get too far into the detail, but anybody got any questions before I move on to the next one? Great. Okay, so apologies for what is a relatively cluttered slide, but for those that are listening that have used valuations before, or have come across some situation or may in the future when they may need to use a valuation. So typical situations where we have valuations in place, I break them down into two situations that are not so great. One is to do with anything from a legal or a litigation perspective. So in that case, you can think of things like shareholder disputes, family law court matters. The second one is for compliance, may that be taxation or financial reporting. So think for capital gains tax or for financial reporting purposes if you need to report the value of your business to investors or something of the like. So the not so good purposes. And then you've got the more positive purposes, which are effectively the first one there is anything to do with a transaction. So obviously, whether we're thinking about putting in place a buy, sell, selling the business, possibly selling part of it, getting additional capital invested, all of those situations, typically there will be a valuation consideration. And then the final piece is purely for a strategic planning purpose, which we'll touch on at the back end of the presentation. Now, the first four bullet points I'll run through very quickly there. So whenever there's a valuation in play for any of those purposes, some of the most common errors that we see, the first one here is what we call the standard of value. Again, this bullet point here, it's very much a legal and valuation-based definition of value, but depending on the definition, so if you've got a valuation report, look at the standard of value because that will really dictate the numbers that come at the back end. So I'll give you an example. So in Australia, we use market value, in particular for the ATO, which is effectively the fair market value if you go into the market and transact the business to any general market participant. Now, this is very much different to what we call an investment value that's available to a specific buyer, typically what you call a strategic buyer that can access synergies if they specifically buy that business. Now, the reason I mentioned that is we had a case recently, for example, so privately held business, bigger in nature, effectively it's a SaaS company. Now, its fair market value is about $10 million, but they had a bid to acquire it by a strategic player for $100 million. So just because of a change in the definition, you have a tenfold difference in the value, right? So it can be highly material like that. They can also be the same or similar, but just something to be cautious of. Now, bullet point 2 there, valuation dates and the valuation purpose. Now, valuations, like many things, are at a specific date and they will be valid for a specific amount of time frame. But unfortunately, the not so useful answer there is it depends how long a valuation is valid for. So typically speaking, valuations might be relevant for about 6 months or 12 months, but it really depends on 2 factors. One is the external factors that may impact your valuation. So in an extreme example, think about something like COVID, right? COVID became very knowable to both publicly traded markets and also privately held businesses in March of 2020. So if we did a valuation of the same business, all else equal, in February of 2020, as opposed to the end of March or April, so only a period of, say, 2 months has passed there, but the change in value would be, significantly different. So you've got considerations of external factors, also more broadly in recent times, the increase in interest rates. Depending on your industry, that can make a big difference to valuation. So external factors, and then of course, internal factors to the business. So all else equal, valuations and the valuation date, you need to consider whether you can use a valuation, say 6 months ago, if you are doing a purpose now that requires a valuation. Now, point number 3, review risk. In particular, this is if there's litigation risk around it, or for example, say historically you've had issues with the ATO, and effectively there's been a red flag raised. Well, if you rely upon a valuation ahead, or you need to present a valuation to the ATO for capital gains tax in particular, then there's a higher probability that the number you put to them for the value of your privately held business will be reviewed. So things like that as well increase the probability of your valuation being reviewed, which means it needs to be more reliable or more defensible, or more supported if it is to be reviewed. Now, final point here, which is something we see fairly consistently, is that clients will get the value of 100% of the business, and then they need to identify the value of, say, a minority, right? So say 10% or 30%, and typically these stakes are non-controlling. So in most companies, most typical operating agreements, you need at least 51%, right, of the shares to have control. Sometimes you might need 75%, right, to do very specific things in the company. So for any minority that doesn't have control of the business, because it lacks control, all else equal, those minority shareholdings are worth less than shareholdings that have control. They're also less marketable in the businesses that we all own, right? Being privately held businesses, because unlike something on the ASX, you can't go and just sell one share. So when you have a minority stake in a privately held business that lacks control and also then marketability, that materially decreases the value of it, all else equal, compared to if you own 100% of that business. Now, those discounts can be in the order of sort of 50%. And we have seen clients in many situations where effectively they do know the value of 100% of the business, but they need to know the value of, say, 10%, and they just assume it's worth 10% of the 100%. That's not correct, and typically it would be worth about half that value, depending on those control and marketability characteristics. So the last couple of bullet points, I won't go into detail there, but effectively, if any of you have relied upon or you have got a valuation report from an external source historically, there's some of the key kind of errors or things to consider that make, a big difference between one valuation report and the next one. 2 different valuers will often come up with 2 very different numbers for the same business, and I'll touch on that more later, but there can be some very basic reasons for that, such as pure things such as errors in the modelling or pulling out the wrong information from financials and tax returns, incorrect adjustments, in particular with privately held businesses when we've got lower quality financial statements that haven't been audited. And then you have a range of practices in there to obviously minimise taxation paid. And owners' compensation, quite often for the key personnel in the business, they're either not being compensated at a fair market value rate, and that might be because they're paying themselves materially lower to leave more cash in the business, or they may be paying themselves materially higher as well. Effectively, from a valuation standpoint, whenever we're valuing something as if it's going to be hypothetically sold into the market, the assumption needs to be made that those key personnel effectively will be replaced in the business. They remove themselves out of it. So we adjust things like owner's compensation to fair market value rates. So obviously getting those adjustments correct, and also things like depreciation, where assets are effectively depreciated in a quicker fashion to minimize taxation, but that doesn't actually reflect the true economic value of those assets. So again, we see that quite often in privately held businesses. So we would adjust the value of those assets to something much more reflective of if you actually sold it into the market. Okay, so the last slide I have on what I refer to as the boring part of the presentation, being more around the technicals here. Okay, great. You know that you need a valuation, as mentioned, for one of our typical valuation purposes, right? So the not so good ones, you might need it for a divorce. You've got a shareholder dispute. Somebody wants to sell their stock in the company. How much is it worth? Or you've given your business to your son, and effectively now for no financial return, and effectively now the ATO says, okay, how much was that actually worth for capital gains? So which type of report do we get and when? So from a valuation standpoint, at least for us at InteleK, regardless of the type of report that we issue, the numbers behind it, i.e. the modelling process and the consideration of both internal factors to your business and the external factors, that process is the same. So regardless of which type of report or output we have at the back end, our modelling process is exactly the same. Now, that is not the same across all valuers. So effectively, you can get some valuations, in particular, if you see the indicative valuation on the right here, depending on which valuation firm you go to, there are some valuers out there that will provide some form of indicative valuation where effectively they consider less information. You know, or as mentioned earlier, there's less of a search to identify the relevant comparable businesses for the market approach, or they don't pay for access to these transaction databases that may have or may contain the comparables relevant for your business. So that's another issue to be conscious of there is the modelling process to get to the actual number, is that the same or is it different depending on the type of report that you're looking at? Now, in the case of us, as mentioned, our modelling process is the same, and effectively then you have three types of reports. One is an indicative valuation, which effectively they are the exhibits from the modelling process. So it's very number heavy, but then we present that, we do this at the back end, either an in-person meeting or you have a closing Zoom call, where effectively we step you through those numbers. So the beauty of that one is that it's a much more efficient process, much more cost effective, and effectively in this case, that's beneficial for the business owner that wants to make key decisions internally, knowing the true, reliable, accurate value of their business. But they don't need a 200 long page report, which they certainly won't read, as would be required if something was in litigation, for example. So on the left here, we've got the detailed report, and very much that is the report that is written ultimately for litigation, those dispute settings, or for the ATO themselves, if they are to review something. So effectively, valuation purpose and the use of the report really dictates what you need. So detailed is very much for those situations. A summary report, go figure. That's a summarized report. So it sits somewhere between the detailed report and the indicative valuation. So that can be really useful. That's the best option where effectively, you know, it might be for an internal planning purpose, or for example, you might be thinking about having one of your employees buy into the company, right? Now, you may not want them on the closing Zoom call where we explain everything, i.e. the indicative valuation. You may not want them there because you may want to hear what we say first before you put a proposal to them. But accordingly, you also want to have a report that you can show them that justifies the numbers and where we get to at a later date and time. You don't want the detailed report because it's 200 pages long, but you do want some sort of report, as mentioned, to provide at a later date. That's where the summary report is really beneficial. So again, it comes down to, in this situation, the users of the report, the valuation purpose, and as I mentioned on one of the previous slides, what we refer to as review risk, right? How probable is it, given the use of your report in your situation, that someone will try and pull that apart, right? Someone will try and contest the numbers. Obviously, if it's in litigation, then the probability is quite high. Obviously, if your business is highly profitable and it's for CGT, the probability is quite high. If it's for your own internal planning purposes, well, provided you're on that closing call and you understand what we say, right, and that's the idea of it, then that's a very beneficial and useful process. So before I move on from there, any further questions around any of the theory? Again, I refer to that as the boring stuff, and effectively that's why you would engage a valuer to look after all of that. But anything, questions around theory or reports, or has anybody ever used an evaluation report and kind of have any questions around how that fits into what I mentioned there? Clear? Great. Okay, fantastic. So now what I refer to as the magic. So now that we have identified what we would call a reliable, accurate, or defensible valuation, then it's all about how do we actually use this, right? We've got this report. There's a number on a page. It says the business is worth 400K, 4 million, 40 million. Great. What do we do now? That's a hypothetical value that is effectively on a piece of paper, right? But how do we actually turn that into money? How do we improve the business? So again, how do we actually use that report, that number, to our maximum advantage? So effectively, as this slide here titled, so we've got our accurate valuation. Now it is time to plan ahead. And then effectively after that, once we have our plan, we then execute the plan, and then we check back in periodically and we review. So like many things in life. Now, the top 4 bullet points here. These are the 4 key things to consider when planning, and effectively they're the main benefits of getting a valuation. So it can help you do all 4 of these things, or one of them individually. So effectively what we call a holistic estate plan. So quite often, it's probably the same for everyone on this call. Each of our businesses, it's one of our key major assets, right? So much time, so much emotion, so much energy goes in it. And then in terms of overall asset allocation or net worth individually, often the business can make up a big chunk, right, of your total asset pool. So it's really, really important, both emotionally and mentally, but then also financially as well. And we'll get to finance and numbers and logic versus emotion in a slide to come. But it's a very, very key asset. So effectively an estate plan, which looks at, the very long term, and that's everything holistically. What will happen with the business if I get hit by a bus tomorrow? What will happen with the business in 10 years' time? More holistically, thinking about my beneficiaries, the family, and beyond, right? So when you have such a key asset in that whole plan, understanding the value of it can really change the decisions you make ahead. And it's quite common when we talk about valuation ranges, even the valuations that we come up with, typical ranges of a privately held business, you can have about a 20% swing under or over value that under fair market value can be considered reasonable. And there's many factors for that, and I'll touch on that a little bit later. But effectively what I'm saying is, let's say hypothetically the business is worth $10 million on our valuation. It would be very reasonable and defensible and quite normal where another valuer could value it at 8 million or could value it at 12 million. So you've got a range of 8 to 12 there, and anywhere in there is what's regarded as reasonable, accurate, and defensible. Now, the point to that is saying that effectively, because each business is so different and so unique, and also each potential buyer places a different value on it, that means that reasonable range is much wider than, for example, the price of a 2-bedroom apartment in Sydney CBD, right? So more assets like that that are much more similar have a much tighter range. So as we know in residential property, let's say the range might be up to 10%, and anything outside of that would not be your typical fair market value buyer. In businesses, those ranges are much, much wider. So the point of that is that when we're thinking about longer term and that overall estate plan, right, and what we want to happen in our personal life and also the business life, obviously, if you get $8 million for that asset, 10 or 12, that can materially change everything that you do. There's also some key numbers around that, in particular for those businesses that are close to the CGT exemption of 6 million. Of course, what you do around that can make a big, big difference as well. And then equally, even if it's only worth 80K or 100K or 120K, as a percentage, that's a big swing that can really change your decision-making process. So overall estate planning, again, it needs to be founded upon what is actually an accurate, reliable, and probable number when it comes to what we call the exit or the liquidity event, which is bullet point 2. So in any typical valuation engagement, one of the questions we have to ask is we say, okay, what are your growth plans for the business? Do you have a plan around an exit? Quite often the answer that we get is, not really. What's an exit? Growth plans, yeah, we've thought about it, but it's not so tightly documented, for example. And that's totally fine. And that's quite a common answer as well, because business owners are doing what you do best, what we do best, and that's focusing on your industry and operations, not certain other things, right? So exit planning is paramount in that if you want to sell the business at some point in future. Now, if you want to give it to your children, for example, then you don't need to worry about this. But if you want to sell it to an external buyer at some point in future, then adequate exit planning to a point where you turn this privately held and quite a liquid asset into some form of cash, right? Planning in advance, sort of 3 to 5 years in advance, is typically how you achieve the best exits. Okay, and then I'll have a next slide here. We'll talk around what exit opportunities are, but you really need to define this in advance and then back solve for what you would like to achieve in terms of an exit and take steps in advance to ensure that that can actually happen. So you need to think about, okay, who do I actually want to sell my business to? Which option would I like to execute? When do I want to sell? And then also, importantly, why do I want to sell? What are my motives there? And it can be financial. It can also be non-financial factors as well. Now, the third point here, succession planning. So in particular, in our privately held businesses, what we quite often see is that there's one or two key personnel in the business, right? Often it's the founder. It might be, if the business has been handed down through the generations, might be one of the children, but more often than not, we have 1 or 2 key personnel in the business. Now, what do I mean by that? Effectively, from a valuation standpoint, we do an assessment in valuation and we say, okay, these key personnel, again, back to the hypothetical getting hit by the bus reference, and we say, if this key person or key persons were hit by the bus tomorrow, what would happen to valuation? And if you recall, the 3 factors we care about are cash flow, growth, and risk. So key personnel get hit tomorrow. How is that going to impact those 3 factors? Now, if the answer is that it will have no impact on valuation, that's inferring it will have no impact on operations, nor our 3 factors. You don't have any key person risk, and that's fantastic. Most privately held businesses, that's obviously not the case, right? So typically speaking, there's at least one person in the business that if they're not there tomorrow, that will have an impact on valuation. Obviously, the magnitude of that depends on the situation. So if it is a case, then effectively, again, leading into some sort of exit, in particular, it's important to think about those risks, right? Come up with a succession plan for that key individual. Often it will be a family member, but not always, so that you can have a succession plan in place and effectively, ultimately work that person out of the business or have a plan in place so that if they leave tomorrow, get hit by the bus, whatever it is, it's not detrimental to operations. Excuse me. Now, in particular with privately held businesses, we consistently see business owners that are approaching retirement where they've worked in the business for many, many years, right? So 30 years, 40 years, and a lot of the value of the business is very much attached to them. So from a valuation standpoint, that's what we call personal goodwill attached to the individual, as opposed to business or enterprise goodwill, where that intangible value is attached to the business. Now, if it's personal goodwill, that makes that business very, very hard to sell. Or if you can sell it, then obviously the valuation is much lower, because unless that person is there, and given it's the business that they built for 30 years, any potential buyer would be concerned that if they sell and they're no longer a shareholder, they'll probably leave, or they'll be much less motivated to continue doing what they were doing before. So again, coming up with a plan for that in advance to make sure that value is effectively transitioned from individuals and personal goodwill to enterprise goodwill. Again, that takes time, right? It takes a lot of time, and it's imperative to get that right for business owners that are still entrenched in their own businesses and considering making an exit or a sale at some point. Now, the fourth point there is quite often overlooked. So valuation is a fantastic tool. And as mentioned previously, we run through the income and market and asset approaches to come up with valuation. And it's a fantastic tool in that it tells us a lot about a business before we go to potentially try and transact it. As part of any valuation process, we will come back to you as the business owner or the CFO or whoever we're speaking with, maybe the accountant. We'll ask a series of questions, right? And effectively those questions, a hypothetical and somewhat diligent buyer would probably ask all the same questions. Conversely, when somebody's looking to make an exit and they engage us to value their business and assist them in how to exit in the best fashion, we can also and are frequently engaged by the other side that is looking to buy a business. So effectively, again, the questions that we come up with would need to be answered again if you happen to find a buyer that has engaged a valuation expert as well. So think of the valuation exercise as kind of like due diligence or a practice run for some sort of exit event. So what I mean by this is typically we'll come through with two types of questions or two lines of questioning. One will be everything financial. So the key input at that point is having high quality financial statements that effectively you can speak to, right? Or somebody, it doesn't need to be you, but somebody on the team needs to be able to answer questions about those financial statements. Again, if and when hypothetically you would like to make an exit for the business. Now that's often with privately held businesses, that's our one main piece of advice. You've got a fantastic business here. It's incredibly profitable. You've done so well to grow it, but the financials aren't in good shape, or the processes aren't in good shape, which means the financials aren't in good shape. And then when you go and ask questions about the financials, the numbers don't stack up. Things don't add up. Bank balances don't match what's in the financials. Now, the problem is if you're looking at making an exit and a potential buyer picks up on that, obviously it doesn't give them confidence that the numbers they're seeing on the page are the reality. That means increased risk and also doubts around growth and cash flow, lower value. So quality of financial statements is, again, it's really, really important. If you're just managing the business yourself and thinking about giving it to your children, kind of doesn't matter, right? But if you want to have an external party look at you to potentially exit at some point, that's the number one bit of feedback, is to have your financial statements in good order. And again, that typically takes 3 to 5 years to make those changes, both operationally and from an accounting standpoint in terms of things of how things are recorded. So to point 4 there as well, doing the valuation exercise, a lot of the recommendations that we come up with, they will be tailored for the exit, but they can also make an impact, again, on growth, profitability, and risk in, day out operation. So that means you can benefit from higher cash flow immediately or next month not only higher cash flow at the exit point by implementing what we come up with through that valuation engagement and the associated advisory piece around the edge. So again, it's not only about maximizing value on exit, it's also around increasing your growth prospects, your cash flow, and reducing your risk day in, day out for as long as you hold that business. So to the last point on this slide here, ultimately all of this planning, right? So all of this planning around estate planning, exit, and succession planning, what does it actually mean? Well, as I've got here, points A, B, and C can do a range of things. Effectively, number one, possibly the most important one here, is that it can speed up the time until the business owner has a liquidity event. So by that I mean it's both when that happens and then also when a business owner decides they would like to sell, how long it takes to actually sell the business. So often business owners that are in better shape will have higher valuations because we have assessed growth, profitability, and risk. When they get a good result from that, it's more likely after that that they'll take that business to market and turn that a liquid asset into cash in a quicker time frame. So it's more likely they'll make a decision that that's appropriate for them sooner rather than later. The second key factor here is that once that decision has been made, that you would like to liquidate the business, some portion of it. And again, we'll get to these exit events in a moment. On average, privately held businesses in Australia, SMEs that are worth from $0 to $10 million, we see the transaction times for them somewhere on average around 7 to 8 months from initial proper marketing. So again, if these recommendations that you come up with, all these factors that we assess in the valuation process, and in particular, as I mentioned, things like improving the quality of financial statements, if these changes are embedded earlier, then that will bring down, all else equal, median transaction time from 7 to 8 months. In many cases, it can kind of halve the amount of time for that business to be transacted. And effectively, then it just means because those risks have been managed, financials and other information is in better state, it takes less time for a potential buyer to conduct due diligence review. There's less issues, if you will, in terms of getting a transaction done. Now, point B, pretty obvious one as well. It can increase the amount that we get upon the exit or liquidation event. Obviously, higher valuation, more probable you receive more cash. And also, if you plan in advance from a capital gains tax perspective, obviously that may minimise the taxation as well. And then finally, again, equally as an important point is the financials or the logic or the numerical. This will lead to business owners or situations where you're happier with those outcomes, right? So again, once business owners typically have decided they want to sell, in many situations we see that they want to sell and they want to get out quickly. So then having to wait 8 months on average, and it can be longer, to convert that a liquid asset into cash can be very mentally and emotionally draining, and in particular for those business owners that have held this asset for many, many years. So again, doing this right, planning in advance, using valuation as a tool to make for a better exit generally leads to much better outcomes across the park. Okay, so now we have our plan. As mentioned from this prior slide, we've done our initial valuation. So we've gone through the initial process, the theory of the boring stuff, if you will. We now know how much the business is worth. We now have our plan here, exit, estate, succession. When we want to exit, succession, we're conscious of key personnel in the business. We now go, okay, well, what are our exit options, right? We want to exit in 5 years, for example. What are the options available to us? So as you can see on this chart here, effectively, we have two considerations. So on the y-axis, we've got the financial readiness, and then below, we have the mental or emotional readiness to make an exit. So we start in the bottom left box. In that case, we have a low financial readiness. So not in the greatest financial state. We still need to consider how much cash we have or how many assets we have to live day in, day out, for example. Equally, we're not mentally or emotionally ready to make an exit from that business. So we're still highly energized. We're still motivated to be working in this business. So a great example, bottom left, would be if you're a business owner of a startup, right? So probably not a flush with cash, not always, but if we make that assumption, you've been in the business for 6 months, a year, 2 years, highly energized. You wouldn't want to sell it to your baby, etc. So that's the box that we're looking at there on the left. So we call that one the stay and grow. So effectively in this case here, if you need further capital, now you probably won't be making an exit per se, but if you need further capital, well, you've got 3 options here. You either recapitalize, so in that case there, you can issue more equity, for example, to raise capital. Go and get debt. Option 2, organically grow. Effectively, you save any profitability, save it, put it in the bank, or reinvest it into the business yourself. Option 3 is what we call the ESOP, so employee share ownership programs. And again, this may or may not be appropriate. ESOPs are a fantastic tool if appropriate for the business. Now, an ESOP effectively, the best thing about an ESOP is that it aligns key employees with the owners or management because they have ownership in the business as well. Now, some of these structures can be quite complex. It can take some time to get an ESOP in place, but if it's done in the right environment, it can be incredibly beneficial both for the employees and also the shareholders of the business. So that is an option from day one. And again, conscious of some people on the call that also may have startups in early stage, obviously not consistently, but a lot of the time with startups, we will see options issued to key employees. So in that situation, it's slightly different where the employee doesn't own stock or equity from one point in time. Rather, you give them the option to buy equity in the company at a predetermined price. And if the business is successful, then obviously the employees benefit. So there's multiple ways of getting employees aligned with the business owners and management. And effectively in that process, the business itself can obviously sell some of its equity and raise capital to invest in future. Now, if we move bottom right, we've then got the very much emotionally and mentally ready to get out of the business. Unfortunately, without good planning, and this is probably half of what we see, it's clients coming to us where they're in this bucket. So effectively, they've had enough. They just want to get out of the business. They've given it a crack. They can't work themselves out of the business, or they haven't tried to do so, and they just want to make an exit really quickly. So in that situation there, it's most probable that the best outcome is effectively to just try and sell 100% of the business. They sell out close to 100% in cash, and effectively you step away from the business. So it's one of the most obvious or quickest options with lowest admin, but it's also probably the case where you're going to get the lowest sale or exit value. So not where you want to end up, but we do get plenty of business owners that end up in that situation. Right, now if we move to the top left here, and effectively this is the wealthy and enjoy work group. So either business has been highly successful or they have a lot of net assets at a personal level. So wealthy, they don't need to think so much about where is the cash coming from to pay rent or pay for the bills next week. So in a very good financial position, and also they're thoroughly enjoying working. So in this situation here, 3 typical options that we see. One is that management buys them out, either in full or in entirety. Option 2, you can gift the business to your beneficiaries. Option 3, the ESOP that I spoke about before. So obviously that's the dream basket, right? Or the dream square you want to end up in. Business has been successful, you're wealthy anyway, and you are still enjoying it. So in those situations there, that is where an ESOP is fantastic. Key personnel in the business can sell down some of their equity to other staff, retain some equity, step back, have a more relaxed role in the business, if you will. Typically, we see those owners taking a role of educating new employees, for example, and high-level relationships with key clientele. So a fantastic option if you can get to that point of the business. Now, the final square there is the financially ready, so wealthy, if you will, and then also ready to go out of the business. Now, in that situation there, it's very similar to the left box. You can gift it to beneficiaries. We then list charity there separately. So no interest, typically speaking, of operating or working in the business anymore. Possibly give it to charity. You've got your ESOPs, you've got your management buyout, and then also your third-party sale, selling 100% to some third party in entirety. So again, some real considerations there that through that valuation process, we will really assess, obviously, the value of the business, but then conscious of it, financial readiness, that needs to be conscious of your overall net assets or asset allocation, but then also those emotional considerations or mental readiness down the bottom. That needs to be factored in, and both considerations of the value and what it's worth and what I could do with that and where I am in my personal life certainly need to be considered when you're thinking about your exit options. Okay, so last slide here before I pause and we open up to any questions. Effectively, now we're at the point where you have the accurate valuation, part one. We've now come up with our exit plan. Okay, so we've now understood what exit options are, and now we're thinking about, all right, how do we actually improve the business? How do we implement some strategies from valuation? And then we constantly review that as we head into that exit event. So to the second point there, the improve and review. So when we go through the valuation exercise, which if you recall, we consider the three things, so cash flow, growth, and risk. Now, at all levels of that, we're thinking about factors, as we refer to, both positive and negative drivers of value. So thinking about risk, growth, and cash flow, there's always factors that are either positive or negative to those outcomes, right? So again, as part of a valuation exercise, not only will we come up with the number, but we can then give very clear guidance and advice after the fact and say, okay, the valuation was only, $1 million. And let's say you thought your business was going to be worth $2 million. So you're disappointed. We come up with $1 million. You wanted $2 million. We can then talk you through the explicit reasons, if you will. So the negative drivers of value that have brought down the valuation, along with the positive drivers that have gotten you to that 1 million mark. And effectively, then you can back solve and say, okay, if we wanted the value to be worth 2 million, what would we need to change? What would we need to do? What are the factors that we would need to make a material change to, and in what priority to bring $1 million worth $2 million, all else equal? So really drilling down into the factors, positive and negative, that impact cash flow, growth, and risk, and effectively then embedding these strategies ahead, right? So we can clearly articulate, clearly identify what they are, and then effectively it's over to the business owner to make these changes to then improve their valuation as they go. So that's the improve and review part, and that can be quite constant. And the best situations that we've come across where business owners have finally had a successful exit, where effectively we've worked with them for about 5 years. As I say, minimum of 3, but ideally 5 years in advance. You do a valuation annually. Sometimes it can be even less frequently, once every 2 years, but just touching base about the negative and positive drivers of value and ensuring that those changes are being systemically made as you move into that exit event. So the last bullet point here is possibly the most useful of all of these. Now, valuation is just one part of an exit or a transaction. Negotiation and then deal terms are two other very, very important parts, sometimes more or less important than the valuation. So what do I mean by that? So now you've got a valuation and you understand the value of your business, or possibly, i.e. an indicative valuation, as we spoke about, or possibly you've got a summary report because you want to show that to a potential buyer, for example. That's just one part of it, right? Then the negotiation comes around the actual price. Now, price quite often can be very different to value or fair market value. Now, the reason for that, there's many, many reasons, but again, effectively a valuation exercise has to be based upon this assumption that a fair market value or a market value participant a hypothetical buyer of your business is rational and logical. In reality, in particular with privately held businesses, quite often we see many things that are not so logical, and that's because there's genuine personal, emotional, and mental considerations as well. So, for example, business owner X might be under a situation where they're forced to sell, right? They need to sell quickly. They need that third-party sale. They need to transact quickly. So because of that, the business will sell for much lower than, say, the midpoint of a fair market value. So there's many, many reasons why a sale price can be very different to fair market value. And again, many of them are mental and emotional considerations that come into play during that negotiation process. So for you as the business owner or your advisory team, if you can understand those considerations, and whether you're selling, understand the considerations of your buyers, or whether you're buying, understand the considerations of the sellers, and then effectively use valuation, knowing where fair market value is, but incorporating those other factors as well. That's where you can get a very favorable outcome for yourself when it comes to the negotiation piece of a transaction. So if you recall to my bullet point 1 there, typical valuation ranges, that can be 20% either side of a midpoint. Now, where you end up, and back to that example where I was talking about the midpoint of being worth $10 million, and then $12 million being the top end of the range, or $8 million at the bottom end, where you end up in an actual transaction there comes down purely to that negotiation strategy. Equally, in privately held business land, we quite often work with clients who go to sell, and effectively there might only be one buyer, right? And a valuation will be presented, like my example, saying, okay, it's worth, let's say hypothetically in this case, the fair market value is $1 million. The buyer comes up and says, great, that's all well and good. Don't disagree with your analysis. I've only got 825K. Take it or leave it. I don't care about your valuation, right? So that happens a lot as well. So again, understanding valuation, understanding how to use it, when to use it, right? When to show a report externally or keep it internally really does impact that negotiation process. Conversely, we've had clients where the buyer hasn't got a valuation, and in that situation, their client knows their business is worth $1 million. Buyers come in and said they haven't disclosed the price. Buyer said, I'm happy to pay $1.5 million. Obviously, the seller knows that's $500K above fair market value. Pretty happy. I'll take that. Thank you. So again, valuation, very different to negotiation. And to my last point there, very different to the deal terms as well. So for anybody here that's been around transactions, it's incredibly rare in privately held business land or with public companies as well, that somebody just pays the entire price in cash up front. So structuring that in the right fashion for the business, and this is again where things like succession planning and ensuring that key personnel are attached to the business for a sufficient time frame through contracts or something like that, if necessary, as part of the negotiation and the deal terms, is imperative to maintain value. So again, quite often we'll see transactions going through where effectively the owner of the business will sell out, receive say 60% in cash, 40% at a later date, and they'll commit themselves to work in the business contractually for the next 18 months to ensure that any residual personal goodwill is transferred through to effectively business goodwill over that transitionary period. So again, deal terms really matter, and that's all part of the negotiation. The last point I will touch on there, and then I'll hand it over to any questions, finding a strategic buyer. So that's bullet point 2 there. I mentioned a lot here, and typically when we value something, we come up with the fair market value first. So that's just an average participant in the market and what they would pay for the business. Now, ideally, you want to find that strategic buyer. That's typically somebody that is in the exact same industry as you, and they can access synergies by buying your business. And by synergies, I mean effectively, because they're in your same industry, and often they'll be a bigger player, they can either increase revenue by having your business in there, or reduce the expenses of the business because they absorb them, they already have those expenses, or they can operate more cost effectively or expense effectively then you can. So synergies is where effectively as a collective, you have value above two entities operating alone. So very much that's the optimal buyer that you want to find. Somebody that's going to value your business much, much higher than any other random effectively. Again, to go through that process and find those strategic buyers, sometimes business owners naturally know who they are. Quite often it can be your competitors. And effectively, if you do operate a highly valuable business, competitors will be looking at that, and often you can get an offer from them at some point organically. But again, a more sophisticated competitor, typically they're offering something much, much lower than the value, and also the value that they're prepared to pay, i.e. come back to negotiation, the skill in that, and also the deal terms to get you that best exit. That's all levered around valuation to understand, in that case, the fair market value plus the strategic value to them, and effectively negotiating somewhere in the middle to get a better outcome for yourself. So again, that process can organically happen, but it can take a number of years to market a business and find those natural strategic buyers at an opportune moment. That's it for the presentation. Any questions?
I have a question.
So, yes.
Yeah.
Go on.
Sure. The last 5 minutes of your presentation has rung in my head for most effectively than the whole. It's got to do with that strategic buyer. So my question is, it's more to do with the chicken before the egg scenario. So a competitor knocks on your door saying, "You're interesting, I'd like to buy you out. Let's see your financials." So how far do you actually work out, hang on, is this for real? Or do they just want to have access to my financials? So it's a chicken before the egg scenario. How would you deal in that situation?
Yeah, it's unfortunately there's no simple answer to that one. From that standpoint, certainly you want a transaction advisor. It depends on the size of the business, but you need a transaction advisor in place just to manage the legal risk around that, right? Obviously, you would need some kind of contract in place, depending on exactly what the IP is that you're disclosing, and also what they're looking to buy, right? So we had one example recently where effectively they were just buying the book of clients of a business. They didn't care about the expenses. They didn't care about the cost, right? So the only value is in the revenue, and then also how they could generate more clients off that. So in that situation there, this client said, "Sure, we'll show you the numbers, but of course we're not going to disclose the clients individually, right?" So show them something, aggregate numbers, but not too much. And then obviously you need to have those legal, contracts in place. But in privately held business land, obviously nobody wants to litigate anybody else. Nobody actually has the resources to typically do that. So you've got to be very, very careful. So there's no silver bullet on that one. It needs to be a bit of back and forth, and again, lots of negotiation and getting comfortable, step by step, if you will.
Okay. So what about I'm thinking out loud as in a sinister standpoint for a moment. So what if someone just wants to know your numbers with no intention of buying in the first place?
Sure. I mean, it depends. What do they stand to gain? Again, you need to identify the buyer before you release anything. Who are they, right? Yeah. What's the background? Who are you? Of course, you wouldn't disclose anything that's confidential or in any way you're not comfortable without fully understanding where they're at. You talk to business brokers in particular, every second inquiry they get, it's a tire kicker, right? Somebody trying to gather information, not genuine. So they have a pretty rigorous process to try and identify if they're even genuine. At the same time, it depends on your business, but releasing aggregate numbers, some business owners are more comfortable doing so than others. So it just depends on your situation. But of course, to get a maximum price from a strategic buyer, and really through any marketing process, you do need to release something, right? So there's risk in that process, and ultimately going for that strategic buyer, for example, higher risk, higher reward, and there's only certain things you can do in that process.
Okay. Thank you.
Andrew, sorry, any other questions there before we go?
Yes,
Hi,
if I may, it's Stuart Ayling here. Hi.
Stuart, how you doing?
Yeah, good to see you again, and thanks, Andrew. It's been interesting.
Pleasure.
I have a question regarding just the general mix of purposes for evaluation. In terms of, I know it's a bit of a general question, but how often is evaluation used purely just for that internal planning side to identify, where's the best area for us to focus our efforts to improve to a certain point versus any of the exit strategies? How often does, what's the split roughly?
What I can tell you is that typically most of the business owners that we work with get 2 to 3 valuations in their entire business life. There's plenty of business owners as well where they've had the business for, say, 20 years. We get engaged typically for, say, a legal purpose where they have to get a valuation. And then you go through this explanatory process, and then after that they go, oh, the annual valuation, that would be really useful, right? So the answer is not very frequently. As I say, 2 to 3 times in the whole business life. Quite often, the first time that will be for the mandated purpose. And then through that process, if they engage a valuer that does effectively the next steps that we do, right, i.e. the advisory and effectively how to use it into exit, then you'll have many, many valuations after that. As I say, kind of annually. So that's increasingly what we do, where we get family law court matters in particular, and sometimes shareholder disputes. They have to engage us. We're engaged. We then chat after the fact, and then after that, it's sort of an annual update to the valuation, and then also you might have a call every 6 months just to talk through the positive and negative drivers of value. Are we on track, etc. So that's the typical transition. I know that doesn't quantify the question so much, but often that's how it plays out. If that makes sense.
Yeah, no, that's good. I understand. So what you're saying there is basically most businesses who go into a valuation process do it for a specific, as you say, some sort of mandated reason. Then they learn from that and realise that there's actually some other value in looking at it. Yeah, absolutely.
What we've run through today, using valuation and also the use of it into an exit, average business owner is not thinking about that. So until they get, either they're a bigger business and they have a CFO or somebody that's just thinking about that side of things, then we get the strategic and internal purposes more frequently. Otherwise, if it's a smaller business, and exactly until they have a mandated purpose to be involved in the process, often it just doesn't organically happen.
Yeah. Okay. Thank you.
Thanks, Andrew. Just one last question. I know we've hit our 12 p.m. Just wanted to quickly ask, what type of, have you seen a spike in businesses wanting to sell currently due to the environment, just in general?
It's been a busier second half of this year. It's still been a very interesting time. I mean, it's always an interesting time, but coming out of COVID, right? You had COVID, then you've had interest rates moving up for the first time in 40 years, effectively, right? So you had COVID impact and COVID hangover, if you will. Then with rates starting to move up at the start of that, we saw some real hesitancy by business owners and also consumers. Just, rates are going up. We've never had this before. How far? What's it going to do? Last 6 months, I feel like people, in particular business owners, have become more calm, that rates are starting to stabilise. We have better vision again. So certainly there's been more transactional activity into the back end of this year. There's no doubt about that, in particular compared to the start of the year.
Yeah, fantastic. Okay, good. Well, Andrew, thank you so much for joining us. Really appreciate your time. Obviously, I've put all your details on chat. Please connect with Andrew. As you guys know, GrowthGen is all about connecting with small business owners. So don't hesitate to reach out to us, and please reach out to Andrew for any more details.